Greetings. We are Faux Shoe, a quality footwear company. Faux Shoe is co-managed by Francisco Amaya, Carrie Guajardo, and Tad Kennedy. Our company was Team A, and we were the BSG champion for Industry 4. Our company's vision is a shoe you can count on, Faux Shoe. Our company's vision is embodied in our mission statement. Faux Shoe is committed to providing quality, affordable footwear for all, from high-performing athletes to lifestyle footwear fans. Our company is committed to the continuous development of new designs and features, offering a variety of athletic shoe options for everyone. Through smart innovation and common sense approaches to manufacturing, we will strive to bring value to our customers and shareholders alike as we aim to become the global leader in the athletic footwear industry. Our overall approach to the market was to offer products which provided more value for the money. In other words, our company sought to employ a best cost provider strategy, in which we offered a variety of models of high-quality footwear at a competitive price. In order to execute our strategy, our product targets were to manufacture shoes of medium to high quality at a moderate price and offering a moderate number of models. As you can see from the graph below, Faux Shoe was able to successfully execute that strategy by steadily increasing our product's SQ rating over time while keeping wholesale prices down. To facilitate the success of our strategy, our company set several production targets. Our goals included expanding our existing plants in North America and Asia Pacific, as well as constructing a new Latin American plant. Our plan was to focus on wholesale production, placing less emphasis on private label operations. As our company's focus shifted towards wholesale production, our approach to the private label sector was to use private label offerings to round out capacity only. As such, our production specifications were set to the industry's minimum standards only. We also offered below-average bid prices to ensure our offers were accepted. Because private label operations were used to meet total capacity only, pairs offered varied widely across years. You may notice from the graph below that our largest private label sales occurred in year 13 and year 15, which correspond with the years in which our company added additional plant capacity. In keeping with our more value for the money approach, Faux Shoe's initial plan was to keep product SQ ratings somewhere between 6 and 8, carry 250 models, and maintain prices that beat our competitors offering similar products. However, as you can see from the year 11 market snapshot, it appears that several other companies within our industry were using a similar strategy. It was clear that our company would not be able to achieve industry differentiation with our current targets. In light of our need to achieve strategic separation in our market, our company altered our original targets to aim for higher quality SQ ratings of 8 to 9, increase our models offered from 250 to 350, and raise wholesale prices incrementally each year. Additionally, we intended to attract and retain retail outlets by increasing our advertising budget while offering additional retailer support. We also determined that it would be necessary to review our actions in comparison to our competitors after each decision year and perform additional adjustments to our targets as needed. As you can see from the side-by-side comparison of year 11 and year 17, by slightly altering our market strategy, our company was able to successfully achieve market separation and grow our overall market share. Next, I'd like to turn it over to our co-manager, Francisco Amaya, who will discuss our company's ability to meet investor expectations, as well as our overall financial performance.
Earnings per share. Going into year 11, we were able to achieve a 36.8% annual growth rate that allowed us to increase our EPS to $3.42, up from $2.50 in year 10. Years 12 and 13, we gained steady increases that brought our EPS to $5.55. Although EPS decreased to $4.97 in year 14, we were still able to achieve a compound annual growth rate of 13.27% throughout that period. Year 15 topped out at $6.92, and year 16 dropped to $5.29. We were able to raise the price per share throughout 5 of the 7 years by selling a minimum of 100,000 total shares each year, while realizing increases in net profit concurrently. However, for years 14 and 16, because our net profit dropped from the previous year, our EPS also took a slight dip. Sales for years 14 and 16 dropped due to us not being able to capture a significant amount of the private label market for those years, as we only captured 24.8% of the Asia Pacific market in year 14 and 25.9% of the Latin American market in year 16. Another factor that affected our year-end net income in year 14 was that we made a capital investment by expanding capacity in our North American and Asia Pacific plants by 1 million pairs of shoes each, which only served to boost sales in year 15. Overall, we met investor expectation by more than doubling earnings per share for those investors that stayed loyal with the company from year 10 to 17. Global market share. On average, we captured more than our fair share, 10%, of each of their respective segments, internet, wholesale, and private label, through all years combined, and enjoyed a compound annual growth rate of 3.82% accordingly. Within the internet segment, the Latin American market led the way through each of the 7 years and really began taking off in the latter years as market share crept up to 15.13%, with Asia Pacific in second place at 14.88%, followed by Europe, Asia, and the North American markets at 12.49% and 12.37% respectively for year 17. Although we expected the North American or Asia Pacific markets to really take off, we experienced the same trend within the wholesale segment and Latin American market too. At the end of year 11, Latin America owned 12.03% and Asia Pacific commanded 12.41% of the wholesale market. Across the 7-year evolution, Latin America experienced the most growth as it took on a compound annual growth rate of 10.96%, followed by Asia at 7.13%, Europe, Africa at 4.62%, and our slowest growing market was North America at 3.762% annually. The private label segment was a tough segment for us to gain a solid foothold in. Whenever we could get into the market, it was hard for us to keep it steadily as competition within the segment and each market became fierce and price wars ensued throughout. Our greatest success came in year 15 when we gained 26.11% of the Latin American market. However, in year 12 we got no traction as each market was overtaken by our competitors, leaving us with 0% share. And in year 17 we decided to increase our private label price, hoping to recoup lost revenues from previous year losses in the segment with no avail. Overall, Latin America had the most success at an average of 13.87% of the private label market. In order to keep up with demand, we made investments in plant capacity in both the North American and Asia Pacific and the Latin American plants in years 12, 14, and 15 respectively. These increases in capacity are noted as the market share in years 13 and 15 increased by a full percentage point. Overall, the wholesale Latin American market was our greatest success as we gained an average of 1 million, as we sold an average of 1,982,000 shoes annually while capturing an average of 17.40% of the market. Stock price. Our investors expected us to grow at a compounded annual growth rate of 6.38%, which projected year 17 stock price at $46.25. Year 11 was a great year for us. We were able to more than double the investor requirement by increasing the stock price to $60.70 per share. Our stock price continued to climb through year 12 to $85.11 and $97.14 in year 13. Because net income dropped in year 14, our stock price was also affected in the same fashion as earnings per share, as the price of our stock dropped by 31.08%. However, we quickly recovered from the decrease and were able to get the stock price above the $100 mark to $107.30 per stock in year 15. Again, year 16 net income was not as forgiving, and again our stock price dropped by 34.17%. Ending year 17, our company bounced back as the price of our stock increased by 62.81% from the previous year. Overall, we surpassed investor expectations in the ending price of the company's stock by $68.76 in year 17, which netted them more than 100% return on their investment. Our investors have been happy knowing that we reduced the amount of stock by buying back what was available in inventory, which only increased the price of stock, and knowing that our consistent A credit rating throughout the evolution.
Our 3-year strategic plan had 4 main goals. Our first was setting and achieving targets above investor expectations in all areas for all years. we wanted to maintain separation from our competitor strategies. We wanted to do this in order to grow our market share and meet our targets year after year. And lastly, we wanted to maintain our first place position in the business strategy game. Our results varied. However, in year 16 was the only year that we failed to meet any expectation or target. I will discuss this further in our competitive analysis after this slide. However, we were able to keep our strategies significantly different from our competitors, gaining market share and meeting targets in all other areas in all other years. In the end, we maintained our first place position and became the industry champions. As discussed in the 3-year plan, we were able to meet and exceed investor expectations and our own for all years except for year 14, return on equity. This was due to Group E's strategic movements that mimicked our own, yet underpricing us. This is why we lost market share slightly in 3 out of the 4 regions in which we participated. In the beginning of the game, through analyzing strategic group mapping, it was difficult to tell who our closest rivals were. However, as the game progressed, it became clear that other groups were attempting to mimic our strategies and separate themselves from each other. Being an industry leader, it was no surprise that one group, Group E, began to closely mimic our strategies while trying to slightly underprice us to capture market share. However, we again changed our strategy slightly to distance ourselves from Group E and maintain spacing from Group C to capture and grow the market share. In examining the North America strategic map for year 17, the last year of the game, it is easy to see that Group A, our group, and Group C would be the next closest competitor and largest market share holders. I used North America as it represented all regions except for Latin America, in which Group C did not expand capacity and therefore could not fulfill any orders in wholesale for Latin America. This gave us significant market share, which allowed us to increase our revenues significantly and also be the industry champions. There are many lessons that can be learned from this game. The first lesson is that firms must remain flexible in their strategies and able to respond to competitor and market movements alike. This can clearly be seen in the previous slides, in which many of our competitors changed their strategies year after year, sometimes overlapping that of our own. This caused us to change our own strategy slightly. We did this in order to maintain separation from our competitors, not only to maintain, but to grow our market share year after year. Another key lesson is investing in production upgrades early allowed for significant savings over time, which gave us a cost-based advantage over our competition. These cost savings were compounded when we increased our production capacity, further adding to our profit margins. Another lesson is gaining market share and profits early in this game for this particular industry proved to give us an advantage for the long run. Another key lesson is investing in capacity expansion prior to competitors gave us a production cost savings advantage and allowed us to supply an ever-increasing demand and our own expanding market share. Another lesson is investing in facility upgrades and capacity early on, in part, has to be financed. Thus, refinancing loans when interest rates are low yields significant cost savings, both annually and over time. The last key lesson in this game for our particular group was strategically separating ourselves proved to be a key factor in our ability in outcompeting other firms in our industry, allowing us to become the industry champions.